So what was it that stood out, and why is Wall Street reacting the way that it is this morning?
Yeah, good morning. Thanks for having me on. Yeah, I'm a little bit surprised. I mean, options were implying an 8% move, and here we are. Netflix is down around 90 to 110 basis points. A pretty muted reaction. I think that the guidance is disappointing on the whole, but I think that as of right now, investors in the street is giving Hastings a little bit of a pass this quarter. Because they are working through price increases that are upcoming. They have a pretty lackluster slate here in Q2 as well. And then with the upcoming Disney Plus launch, if there was ever a time for Netflix and company to be a little bit conservative, they kind of just delivered that last night, and people are looking beyond it. But clearly, subscription fatigue is going to be something that people keep an eye on, but probably for the years to come, not going to be 1 or 2 quarters in the near term. And if obviously subscriptions start to decline, the multiples is at risk.
It seems to me, Joel, that the one place that Netflix has a real competitive advantage when it comes to online streaming is, first of all, the first mover advantage. Second of all, they've already got years of experience doing original content. How does that play into the thesis as we see Disney Plus trying to come onto the market, and also Hulu with its strength recently as well?
Yeah, I mean, with Netflix, you can't underestimate. They are the leading platform. They've kind of led the global secular shift to streaming. And that's just kind of the way how the shifts of how content is consumed. They're at the forefront of that trend. And it's definitely their war to lose. And I do believe for the foreseeable future, Netflix is going to remain the platform of choice for households across the globe. And then other kind of offerings, whether it's Disney Plus, Apple TV Plus, more content coming from Amazon, they're going to be the complementary services to attach to Netflix. But end of the day, as far as content goes, Netflix ended 2018 with 700 plus series, while Disney's going to start their platform with 25 series. Netflix has 55 planned movie releases this year. Disney's looking at 10 plus. So as far as content goes, they are so far ahead of the curve. It's pretty incredible. And they're going to outspend Disney by about 5x through 2025 as of now. So, I mean, they're well ahead of their competitors.
Can we talk demand elasticity at some point here, Joel? Because the thesis right now is this idea that as more of these platforms come on, they're charging more money. Consumers don't have an unlimited amount of resources. Do the price increases at Netflix bode better or worse for its prospects overall down the line, given the competitive environment it faces?
Yeah, I think time will tell. And I kind of think like a company like Amazon could be the dark horse. They are spending $6 to $7 billion a year. So I think Netflix, their pricing power, after we saw what Disney kind of unveiled last Thursday, it just took a little bit of a hit. We know YouTube TV recently increased their prices as well. There's a lot of competition out there, and I think they have to be a little bit more careful. As you said, the term subscription fatigue is starting to gain a little bit of traction. And, right now I think the average U.S. household has about 3 subscription services. So how many can people have? Maybe 4 to 5 max. But anything beyond there is probably unrealistic. So I think, like I said, their pricing power after the Disney low price point introduction, it got a little bit of they have to be a little bit keep an eye on it, and they probably have a limited upside from here.